Good afternoon, everyone. Thank you for joining us today. On behalf of the National Bank of Fujairah, I am pleased to welcome you all. I am Gavin Quass, and I'll be hosting today's webinar. To continue with the session and insights, today I have on the panel with me Bharawaj Raghavan, Interim Head of Treasury Sales at National Bank of Fujairah Treasury Department, and also Mahesh Govindan, who is Senior Corporate Dealer at National Bank of Fujairah in the Treasury Department. Hello, gentlemen. This webinar is part of NBF's knowledge sharing efforts, where our aim is to increase awareness of common trends, challenges and opportunities to help individuals and businesses with resources not only to operate but grow and develop even further in today's transforming environment. NBF efforts and services are continuously recognized by a number of industry accolades, including the recent titles of the Best SME Bank and Most Innovative Emerging Technology Implementation by MEA Finance Awards. You'll also see a poll, should be on the right, so please share some feedback. There'll be some Q&A at the end as well. Towards the end of the webinar, we will have a Q&A session. So in case you have any questions during the session, please feel free to share them through the Q&A tab, and we will address them at the end of the session as much as possible. So today's webinar is quite exciting. Obviously, it's going to discuss about a very interesting area, particularly within the Treasury function. But if we look at it, the global market outlook and tackling market volatility challenges for corporates. Certainly an interesting time for corporations at the moment. Wouldn't you agree, Graham? So I just want to recap on a couple of bits that we will talk about. The first thing that we'll probably talk about on the agenda is sort of market updates for mainly the three different zones. So that's the US, the eurozone, and obviously the United Kingdom. We're going to be looking at the commodity outlook, particularly within the gold. And then we'll be talking about MBF Treasury products and services, including its digital offering, NBFX. So here's just a snapshot of some of the inflation numbers as against central bank target rates. And as we can see, we have the headline inflation rates. Obviously, the lowest there being 3.5 in Switzerland, as high as 10.1 in the UK. Quite a spread. Sorry, Japan's slightly lower than Switzerland, but quite a spread. But you can see when we look at that against the central bank target rates of 2% and 1%, quite a big variance. And again, our two speakers are going to talk about that in detail. Again, this just gives you I guess, a graph to look at that's looked at the last coming on 10 years and how inflation has sort of increased, decreased, but certainly the volatility of increase, particularly since the middle towards the latter part of 2020, which is when COVID started, and obviously what has happened for the three different currencies. So I'm going to get our first speaker, Bharawaj. Can you hear me?
Yes, Gavin, thank you.
No, well, you might have to speak up. It's slightly quiet.
Yeah, hi.
Yes. So do you want to just give us, I guess, an overview? If we look at the US being obviously the major denominated currency, just if you want to give us an overview, I guess, on what has caused this inflation to accelerate at the speed it's increased. And I guess, how are the central banks responding to this rapid increase in inflation?
Sure, thank you. As you said, I think if you look at the chart on the left, it gives you the numbers, US inflation numbers over the last few months. In the month of June, it actually crossed 9%, not seen since 1981, which is a 40-year high. It came off a bit in July, mainly on account of lower fuel prices. But the point to remember here is, as you said before, the central bank inflation targets are much lower. For the US, it is at 2%. So any number which is around 8-9% is extremely high. I think talking about the reasons why inflation has been so high, I think one of the most primary reasons I would say is the expansionary fiscal policy followed by the US government under Donald Trump to begin with from March 2020 onwards, and under Joe Biden as well. So the kind of the economy, the support which these governments gave provided a lot of disposable income to the households in the US, naturally leading to some demand side inflation. Even on the monetary policy side, US Federal Reserve kept the interest rates zero for a prolonged period of time. And also their expansionary policy meant that the balance sheets of these governments actually went from $4 trillion to $9 trillion in just a couple of years' time. Some might argue again that U.S. Federal Reserve was a bit slow to react. The first rate hike came only this year in March, and it was a mere 25 basis points. Was it enough? This is something we all can debate upon. But the point here is that they failed to keep the nominal interest rate ahead of inflation, and that's why you see numbers like 8 and 9%. Now, again, looking on the supply side, there have been some supply shocks coming in. We all know the Russian-Ukraine crisis actually sent the agri products through the roof, especially corn and wheat. Both these countries are major producers of corn and wheat. We saw how the prices went up. They have seen some corrections post that, but they still remain at elevated levels. And also, if you look at China, the Chinese COVID-related lockdowns have led to supply-side inflation because a lot of industries were actually shut for extended periods of time. Now, again, all these factors are on the supply side and demand side. And it's easy to say that inflation is 8 to 9%, but even if you look at the core inflation numbers, if you exclude the volatile prices of food and energy, the core inflation numbers were elevated as well. It was at 5.9% in July. And in fact, the August numbers will be out tomorrow, and we expect those numbers to cross 6% again, because you're taking out energy prices, you're looking at core inflation numbers over there. So U.S. Central Bank doesn't have much of a choice right now but to increase interest rates. On your second point on how would central banks respond, I think they unfortunately the central bank doesn't have too many tools in their hands at this point in time. So I think the major tool which they will be using again is hiking interest rates to control the money supply in the market. If you look at all the if you look at all the major central banks like the Bank of England, the Reserve Bank of Australia, the U.S. Federal Reserve, so all these central banks are in the midst of a rate hiking cycle. And even last week, if you saw, the European Central Bank hiked rates by 75 basis points, and it was the highest ever done by the European Central Bank since inception.
Yeah, certainly a very volatile and interesting time. And what about unemployment? It's interesting to see the difference that's had.
Yeah. I think increasing interest rates will have its costs. Unfortunately or fortunately, it will have some kind of a direct, indirect effect on employment rates. The unemployment rate kept steadily coming down, as you can see on the right-hand side of your slide. It came down to 3.5%, but it started going up a bit to 3.7%. Now it's a very small increase. But what we need to see here is, there hasn't been an uptick since March 2020. This is the first uptick which we see in unemployment rates, and this is purely because of the kind of monetary policy the Federal Reserve has been following. No, I was just going through some reports, and I actually read one report which says that it was research done by a US-based consultancy firm. They say that it would take 5.3 million lost jobs and an unemployment rate of 6.7% for the inflation to be lowered to the central bank's target of 2%. So there has got to be some kind of a social cost around increasing interest rates. So that is something we can expect. But again, on the positive side, the other data which actually I was looking at as well, right now there are 2 job openings for every unemployed person in the market in the US. So even if the number of vacancies actually reduce on account of rate hikes and suppression in demand, there may not be a significant increase in unemployment rate this time around.
Let's have a look at the next one. So I guess one of the things I've gotten here, and we've already got some questions coming through, so that's quite good. But how have currency markets reacted to these numbers?
Yeah,
particularly say the US.
Yeah, I think dollar has been absolutely brutal this year. It has appreciated against all the majors like euros, sterling, Canadian dollars, Australian dollars. Not just that, even the emerging market currencies. But something which stands out is interestingly, Whenever there is a risk of scenario, Japanese yen tends to gain. But this time around, if we can move on to the next slide, please. Yeah. Here, we see the comparison between how dollar yen has performed since the start of the year, as against risky assets like the S&P 500. S&P 500 has fallen close to 20%, but at the same time, the Japanese yen has depreciated as well. So the Japanese yen has not been able to hold on to its safe haven status somehow this year. So that's why I said, I mean, dollar has been absolutely brutal and has appreciated against all currencies. In turn, in currencies like euro and sterling, since they have depreciated by around 15-20% this year, it has also led into import side inflation into those countries.
Yeah, interesting. Housing market, because that's always an interesting part that has an effect on, you know, whether it's inflation, whether it's rate hike. You know, are there any sort of warning signs, bubbles that people need to watch out for, you know, with relation to the US market?
Yeah. Again, looking at the chart on the left, which gives you mortgage applications, in the US, it dropped 0.8% in the week ended 2nd of September, and it is a fourth consecutive decline. Compared to a year ago, mortgage applications are down 63%, and that's a big number, right? And even on the new home sales data, which you see on the right-hand side, it plunged 12.6% month over month to a adjusted number of 511,000 in July. And it is the lowest reading which you see since Jan 2016. Now, the obvious reasons for these are, you know, the increase in the borrowing cost for the individuals, and at the same time, the prices of housing markets have gone up as well, and there is a general fall in demand. Just to give you an example, the US mortgage lending rate has climbed sharply from 3% at the start of the year to 6% by July, so putting brakes on this part of the industry. Now, if anyone remembers Robert Shiller, the American economist, he released a book in 2000 called Irrational Exuberance, and he had predicted the stock market bubble. And we had the tech bubble burst at that point in time. And then in 2004, he actually wrote a paper a paper which was titled, "Is There a Bubble in the Housing Market?" And then we had a housing bubble burst in 2007 and 8. Now, interesting to see what he says this time around. He says things can be bad again, but thankfully, he says that he rules out rather any catastrophic event this time around. So, which is actually kind of a relief for us as well.
Good. I guess, is there a few things that our listeners can take away from you know, some of the commentary?
Yeah, I think we have covered most of these, but if you look at point number 3, it's a bit interesting. When we look at historical data, now between 1970 and 2000, the average length of time between the last rate hike in a cycle and the first rate hike was only 3 months. And over the past 2 decades, it was 3 quarters. So what it basically tells you is, although US is increasing interest rates quite rapidly, 75 basis points expected again this month, and maybe another 50 and 25 basis points before the end of the year, and probably one more rate hike of 25 basis points in the first quarter. This historical data kind of gives you some kind of an idea when US will start cutting rates as well. Although you know, the previous Jackson Hole meeting, many of those US Fed governors ruled out any interest rate cuts next year.
Yeah.
But historical data actually suggests otherwise.
Interesting. Let's have a look at, I guess, the steep rise in cost of hedging.
Yeah. So again, this chart basically tells you how much your borrowing costs have actually gone up, be it working capital or term loans. So what we do from NBF is we engage with our customers to see how their loan book stands and see how we can hedge their cost. Doesn't matter if it's a working capital loan or it's a term loan. We sit with them and see how we can fix their cost so that they don't have to worry about increasing interest rates.
Okay, that's great. I think some of the listeners might be interested in certainly having that discussion afterwards. If we look at the eurozone, so slightly different, and I think one of the questions already just come through on the eurozone, so we're just getting through to it now. But what is feeding the inflation in the eurozone might be slightly different than the US. You know, the markets are very, you know, different in terms of isolation. Obviously, what's going on geopolitically? What's feeding that sort of inflation in Europe?
No, you're right. I think the dynamics are different in the eurozone. In the US, it is more like demand-fed inflation and supply-side inflation. But I would say on the eurozone, it is more of a supply-side inflation. I think the primary reason for inflation in the eurozone is the steep climb in energy prices. You have seen Russia actually stopping the Nord Stream 1, its main gas pipeline to Germany, in retaliation to European Union trying to put caps on prices on Russian oil exports. So that energy prices have certainly climbed, and that is actually causing the governments in the European Union a lot of a lot of things to be taken care of. Now, interestingly, the governments in eurozone have to actually need to balance between two things. One is they have to provide relief to the households for reducing their cost of their energy bills, but at the same time, they have to basically try and dissuade the households to stop using, not entirely, but at least move away from Russian oil, Russian gas as such, and move to more renewable resources, green resources. So if they keep giving subsidies like they did in Germany for this month for around 65 billion euros, France did it last month, and again, UK's new Prime Minister, who was just elected last week, she has already announced a lot of measures where she promised that the energy prices for the households, average prices will not exceed 2,500 pounds for the next couple of years. So this is going to cost the exchequer at least 100 million pounds over the next couple of years. So these kind of factors, although they will put a limit to the inflation rate at this point in time, we should remember that the government borrowings is going to go up, and any subsidies which are passed on to the client means more disposable income, and inflation can actually remain elevated for a longer period of time. Having said that, on the demand side, again, inflation remains quite weak. The demand side inflation remains quite weak in the eurozone. The output gap is negative, and household consumption is well below the pre-pandemic levels. And retail sales have in fact been on a declining trend since November.
Interesting. If we look then at the UK, you sort of mentioned there, obviously, the new Prime Minister Liz Truss, and obviously her sort of policy that she's discussed. So, you know, do you want to give a snapshot for our listeners, maybe on the UK market? You sort of mentioned a couple of points there that they might be able to sort of get some feedback on.
Yeah, sure. Euro and sterling have depreciated against the dollars, as I was saying before. This has fed into inflation. GBP, for instance, has fallen around 15% since the beginning of the year. UK inflation has gone beyond 10% for the first time again since 1980, and both headline and core inflation rates have come in above expectations. Now, the problem for the Bank of England is, the hiring as such, the hiring demand is fading. But at the same time, there is a skill shortage and labor supply issues that have plagued the jobs market for quite some time. And it is showing very limited signs of improvement. So as you can see on the right-hand side of the presentation, the consumer confidence has been dwindling. It has been falling month on month. It just shows that people don't have any more confidence in Bank of England or the UK government, and it is reflected in these numbers. So very similar picture in UK as compared to the Eurozone. I think inflation is here to stay, and even on the growth numbers, Bank of England is actually forecasting just around 2% fall in GDP over the next couple of years. So that's not very good news on the UK side as well.
Okay. I think this is where we'd like to probably introduce our next speaker. Mahesh, are you there?
Yeah. Good afternoon, everybody. I hope I'm clear.
Yeah, well, no, we can hear you. We know you had some technical issues, so thanks very much for joining us.
Pleasure.
Obviously, when you have volatile markets like this, some of the safe havens, oil, gold, seem to be very attractive for whether it's investors or people looking at more of a safe haven asset. I guess what I'd like to get for the listeners is just a bit of an overview on gold and a couple of questions, if that's okay.
Sure.
Yeah.
So currently,
I was going to say, do you want to give an overview for the listeners, and then I'll sort of maybe ask a couple of questions?
Sure, I'll just start off with an overview as to where the current levels are. And because it's pretty interesting to see the gold chart actually. If you look at it, it's been gold has been bullish. It's gone up, made a high of 2070, and since then it has not exactly tried to breach those levels. It has touched there and always come back. But and now right now it's at a key level of around 1680. It's been trying to break that level for quite number of times, at least 5 times. And even as we speak, it has actually didn't it just went close to that, bounced back 1690, 93, and then it bounced back again. So I think that's a very key support, and I think everyone is aware about that, as to what that level, how that level is sustaining, and then hopefully it doesn't break. But I mean, there's a scenario there's always a question as to what would happen if that is breached. I think, Gavin, you were probably pointing towards that.
So go on.
Yeah. So it's a very, if you look at this chart, and I've put it, I'm not sure whether it's that clear, but if you look at this pattern towards the left-hand side of that graph, it's something very similar pattern that we see on that graph, where gold made a high, it was trading around maybe 1570, I think, and it was there. It traded. It didn't break that support, for quite number of times. And once it broke, you see that drop down below. I think it was somewhere in 2013, right? And then it stayed there for quite some time and then gone back. So we are looking at something very similar pattern, purely from a technical perspective. We are looking at something very similar pattern, and probably, if from what I feel is that if it breaks that level of 1670, 80, a comfortable break, probably we could see it go lower. But as of now, it's holding pretty well. So I think it's still on a bullish trend at the moment.
Well, I was going to say, you sort of mentioned it there, but what would be the scenario if, I guess, that support is breached? And will a strengthening US dollar have any impact on gold prices?
Absolutely. I think gold has to be looked at in conjunction with the dollar index. And I think that's where, I think if you can go to the next slide, I think maybe I can explain better to all.
Yeah, that would be great.
Yeah. So again, if you look at this is pretty, again, I put it a longer chart just to show the correlation here. If you see, the top side is the gold prices, the second is the down below is the dollar index. And it has always behaved in a way where the dollar index has weakened, the gold is higher. And again, when the index goes up, gold prices comes down. And right now we are at that cusp where the dollar index has been moving pretty high, and gold is yet to react to it. So that raises this question of, how gold would move, and that considering that point of that 1670 around support levels, it's still yet to break. So, I mean, that's where it is. It's at a cusp of some kind of an event that could trigger it. A downside, or it could hold on and continue to trade higher. On the higher side, I don't think there will be much of a movement, because there are many factors at play here. The dollar index still, it is still strong at the moment, and probably gold may stay subdued, if not lower.
Certainly an interesting time, with everything going on, and this, it's quite an abnormal. Well, probably hard trying to predict to a certain extent with some of these, because they're sort of moving in different directions depending on what one impact has on the other side. So certainly interesting time. Yeah. I guess one of the questions here is just talking about a hedge against inflation.
I mean,
that'd be a question mark for some people, because it's certainly of interest.
Yeah, I mean, here, I mean, it's open for everybody to answer this, actually. I mean, a rather debate on this. I personally don't think that gold is a hedge against inflation. There are many a times where the chart, what it shows is comparison with how the CPI, which is inflationary data, has moved along with the gold prices here. So if you there are times when, for example, if you look at that area between just prior to 2002 to 2008, where we see the interest rates are going up, around like very fast, but then gold has not moved that much. And then when the rates actually go down, we see gold suddenly breaking out, making new highs, and those kind of scenarios. So it's actually a very very debatable issue, I feel, if not where we have gold is considered as a hedge against inflation. Right now, even as we speak, when the rates have moved exorbitantly high, I mean, this inflation data has moved. Inflation data shows an exorbitant rate, like 8.5% at the moment, but gold is still there. I don't know how that will behave. So it's just a question for everybody, I would say, to whether we should consider that as a fact or whether it's just a myth.
What are what are some of the other factors to consider for our listeners?
Actually,
and I'll get you to sort of go through these because I think they're important.
True. The other factors, I think I just had a look at the ETF funds. We have seen 4 consecutive gold ETFs. There are 4 consecutive months of tonnage outflows, which means there are a lot of liquidations happening in gold, and the net long position also remains low on the side. So that gives you an indication of how the market might behave going forward. But then to counter that, there is central bank buying as well, which is robust, which has always been robust, to be honest. Central banks have been buying gold. I think since 2010, they have bought I think around 460 or some quantity. I'm not sure about the exact quantity there, but at least for this month, we have seen Qatar buying, Turkey buying, India as usual. It's always there. The central bank buying of physical is there, but on the other side, we see ETF funds liquidating. And ETF funds are always backed by physical gold. Then there is this this risk of recession, like Bharat was pointing out in the earlier slides about high rates, but but they are in a catch-22 situation as to how unemployment also has to go up. Unemployment has to go up. It's not good for it. So it raises this question. But during these times, generally, we have seen gold gold prices benefiting and staying high. So it is. There are a lot of events at play here, not just purely the dollar index, but yes, there are a lot of other events that could also play into gold's hands, and I think it's a very interesting time as far as gold is concerned. Right at this point in time, kind of both ways, it could move out depending on how the solutions come out.
So I was going to say, if I get Bharawaj back in, Mahesh, if that's
sure.
Okay. Bharawaj, are you there?
Yeah, hi.
Bharawaj, for the listeners, do you just want to sort of give an overview on MBF Treasury, I guess, products and offerings that obviously could help out some of the customers that are listening?
Sure, Gavin. NBF Treasury offers hedging solutions for its customers in pretty much all asset classes, be it foreign exchange, interest rates, or commodities. We also offer high-yielding structured deposits if a client wishes to earn more interest than their regular fixed deposits. We have Islamic compliant products as well, and we offer digital solutions to our customers in the form of the NBFX platform, which I can talk about in the next slide. And we also do provide updated newsletters to our customers to keep them up to date on the market. So if someone wants to subscribe to those newsletters, you can go to our website, and under the Treasury page, you will be able to subscribe yourself. And it is pretty much sent every day. It covers a lot of asset classes, and it's all in brief, so it won't take too much of your time. It's a couple of pages, and it will give you a good overview of where the markets are at this point.
Very good. Do you want to just overview again with some of the listeners what that platform involves as well?
Yeah, sure. NBFX is a digital platform, again, offered to our customers to hedge their FX and precious metals exposure. Clients can book spot, forwards, swaps, NDFs through this platform. What is unique about this platform is it offers the flexi forward, what we call in this market. It is a product wherein a client can actually choose the date on which he or she wants to utilize the forward contract. So it's pretty unique. It is offered by other banks as well, but over the phone. But NBFX is probably the first platform to offer this kind of a product, and on the platform. So there is also a robust order management system which allows clients to place stop loss orders, limit orders, and even for our precious metal customers who like to place AM and PM fixing orders, even that is possible on this platform.
Oh, excellent, excellent. I'll just I'll go to the next one. Now we've got some Q&A that's come through, so I'm just going to run you through some of these. Just very on, I think one of the commentaries that was mentioned there, I think when we were talking about US unemployment numbers and obviously 2-to-1 jobs, I think one of the comments there was that it sounds like a skills gap is a shortage, and certainly from my own research, when I've looked at the Australian market, I think the Australian market, they've had to increase migration numbers just simply because they're running out of people that are with skills basically that they need across various sectors, from nursing to engineering, etc. So that's going to be certainly an interesting time that is going to happen, and what that's going to do to unemployment numbers as well.
Yep, very much. It's a very valid point, actually. The unemployment rate and the interest rates. So it is basically, it's a relationship which many economists have debated on, the relationship between the two. Now, if generally what happens is interest rates go up, unemployment rate also increases. It's kind of an inverse relationship. But this time around, what is interesting is although the employment levels are pretty low, historical lows, there is certainly a skill gap out in the market, which is actually driving wage inflation, which is in turn contributing to the higher inflation numbers. So it's a very valid point, and I think it is something which we need to closely look at. In fact, one of the US Fed governors had recently talked about how this time around US interest rate increases will not affect the employment levels the same way it did before. So that is something to probably have a look at as well.
Well, I was going to say that brings us back to the same point I was saying to Mahesh. It's very hard to predict at the moment. There's 5 or 6 different moving parts, and it's not exactly following the exact sciences beforehand. A couple of questions I've got here. What is the outlook on crude prices?
I think it's a very pertinent question to ask in this region. Crude prices have been on downtrend from June onwards, and I think the primary reason behind them is one is aggressive monetary policy tightening, which we were talking about before. So if you increase the US interest rates, for example, and with dollar strengthening, it's obviously going to get very difficult, very expensive for the consumers to buy dollar-denominated oil. And at the same time, you've also had, lockdowns which are coming up, lockdowns which we had in China, and again, they are springing up. So I was reading a report yesterday, in fact, that the couple of provinces where China lockdowns have been introduced, the population of those 2 provinces put together is equivalent to the population of Canada. It's around 38 million people. So if you have so many people in the lockdown, obviously the energy consumption is going to be lower, leading to lower oil prices as such. So the factors to watch out for in terms of support to oil prices, one is, I think again, we talked about this before, the feud between European Union and Russia, which can actually keep the prices going higher. And also the recent meeting, which was done by OPEC Plus, where they decided to cut the oil output by 100,000 barrels. Although it's a very small number, it goes to show that they are ready to even hold an emergency meeting if need be, if oil prices keep going lower. So I would think that oil prices will be supported or may have a floor, the Brent prices between $80 to $90 in the short term. And if prices go below that, I think OPEC will come in and quickly do some kind of a output cut so that the prices are actually supported. And probably moving back to $120, $25, which we saw earlier this year.
And I'm not sure whether yourself or Mahesh wants to cover this one off, but what tools are available to hedge euro as the currency has been effectively depreciating and has affected, I guess, some people's receivables from exports to the eurozone? Would you like to cover that off, Bharawat, or would that be you, Mahesh?
Sure. Right now, people who have euro receivables, I think they uh, uh, have to be really be worried about, because simply because the it's not looking good for Europe in any way. With this war, generally wars don't end that soon. It lingers on, and especially when you have energy issues, which is very critical, and I don't think they can replace it overnight, obviously. So euro will be under pressure. So I think I mean, some action has to be taken for customers who have the euro exposure, especially if they are receivables, where they can do simple vanilla forwards at least. Where
Yeah.
they could sell the euros for a future date, have some visibility. If they have some visibility over the cash flows, then probably they could do simple vanilla forwards. Or we can always look at designing a particular structure something to them for them, based on the cash flows that they have, using the derivative instruments. And I think that is something that we should all look at least a vanilla FX or if somebody wants to really have it in a very in a very structured way, then we could look
Yep.
at derivatives also on that side.
And I think we've just got time for a couple more questions. Again, Barry, I'll probably come back to you, but are borrowing costs in the AED, sorry, let me start again. Are borrowing costs in AED expected to remain elevated? And again, how can they be hedged?
Yeah. See, fortunately or unfortunately, the dirham interest rates have to move in tandem with the U.S. interest rates, because the dollar dirham is a pegged currency. So UAE central bank will have to increase rates when the US is doing it. This year, I think around 2.25%, we saw an increase in the dirham interest rates. So unfortunately, yes, borrowing costs are likely to go up this year further as the US increases interest rates, and likely to remain elevated at least till the mid of next year. So if clients are looking to hedge their exposure on interest rates, we would be happy to assist them in this regard. We can have conversations with them. We go through a very detailed treasury appropriateness questionnaire where we try and understand what their client requirements is, what is their sophistication, and accordingly suggest products and services which can benefit the clients.
And I think lastly, can NBFX, can that be used to buy physical gold, Mahesh?
Yes, they can be. They can be very much. The platform is basically can be set. The deals on the platform can be settled in physical format, where the client can get ounces against it, and they could, in return for those ounces, they could take physical. We are one of the few players, or rather, I would say, just one of the top two players here on when it comes to physical gold, lending physical gold. We have a very active unit that way in precious metals, which takes care of this part. So the platform is designed in a way where the clients can have physical gold taken against it in physical format. It could be in TT bars, or whatever quantity that they buy, they can take in that ounces. Physical delivery of those.
So I think just to recap for our listeners, I think obviously still some volatility in the market, both across different regions in the globe. I think obviously we've discussed about the potential of rate hikes across again in multiple different areas. But I think what's interesting is, the US, the eurozone, the UK, even in Asia, the markets are affected in slightly different ways because of their own economic situation or what is actually going on geopolitically. So certainly, I think if any of the listeners are interested and they'd like to have some more information, you can by all means reach out to our speakers, Mahesh and Avri Barawaj, and they'd be happy to help you, even if that's in conjunction with NBFX. Please feel free to reach out and they'd happily have a chat with you. Gentlemen, thank you very much for joining us today. Really appreciate your insights, obviously knowledge and what we've been able to present. And to our listeners, again, thank you very much for joining us. As mentioned at the very, very start, this is part of MBF's knowledge series. So we're going to have some more follow-up sessions in relation to this. So please keep an eye on our social channels for any more upcoming events. Again, thank you, gentlemen.
Thank you. Thank you.
Thank you.
Nice. Thank you, everyone, and please have a good day.